Hello, class. For today, I'm going to go over the expected values of a question with dealing with the insurance. The reason only why I'm giving you this question is because on the quizzes and tests, I have a question like this for you ready, so that once these types of questions arrive, you guys should know how to do these. Um, but before that, let's go over the deductible and premiums and how that works. Okay. In anything, car insurance, you're going to have something called a premium and you're going to have something called a deductible. Now, premium is something that you guys pay every time, like every month. Like when you guys have a Netflix or a Crunchyroll, you guys have to pay some sort of amount of fees, depending on whether you guys can hack into the system or not, but that's up to you. But let's say that you have to pay a couple dollars every month to provide you with that service. So premium is pretty much that, what you pay every month. Deductible is how much you pay in addition in case you get into an accident only. Okay, so deductible you only have to worry about if you get into an accident. So for example, let's say that you get into an accident and your car is really damaged and it actually costs you about $2,000 for you to be for you to be able to fix that up. Now, what's beautiful on insurance is that it gives you something called a deductible because we know that paying that out of your pocket is going to be ridiculous, right? So a deductible is the amount that only you pay, and then the rest the insurance covers it up. So if the total damage is about worth $2,000, if you have what we call a 500 deductible, it means that you're the one who is going to be subject to be paying for that 500 bucks. The rest, which is $1,500, the insurance covers that for you. So that's what's really beautiful about insurance is that you don't really have to pay this ridiculous amount. The vast majority of it is going to be covered by insurance. Now, what is $0 deductible going to mean? It means that no matter how badly the damage of the car is going to be, you only pay $0. Like that's great, right? Because that means that for a person who get into a lot of car accidents, it means that you essentially have to pay $0 for any damages or to the cost of the car that needs to be made in order to fix it. But what happens to the premium then? Look at the pure premiums. There's a pros and cons to it, right? Every month you're paying $10 more, which means it comes out to be like $120 every year. It does cost you extra for this better benefit. It costs you less, but once you do get into an accident, you have to pay the $500 deductible. Now, what if the total damage to the car was $499? Well, it means that you're actually subject to paying $499 because your deductible goes up to $500. The deductible is the amount that you are subject to paying. The max amount of deductible that you have to pay out of your pocket is $500. So if the damage to the car was less than $500, let's say for example $499, you're subject to paying for the whole thing. If it was actually more than that, let's say $2,000, then you only pay $500 and the rest insurance covers for it. Okay? So now that you know what premium and deductible means, let's talk about expected values. So the exact expected value of Plan B is very simple. Plan B is $60 that you have to pay. Why? Because there's a 100% chance in which you have to pay the premium. That doesn't change, which is just one. So that then your expected value of payment is $60. And then for Plan A though, it's the same thing with $50. So in a sense, if you were the customer, obviously you would go for $50 because that's cheaper, right? But notice how we say that there's 1% annual chance of the car being totaled. Okay? So if there's a 1% chance of the car being totaled, what that means is we want to make sure that we pay this deductible, $500, and then let's say you get into a very, very, hard car accident, but then you have to pay $500 for that because that's your deductible, right? Times 0.01. Now there's a percentage of car being totaled with the cost of the value, so it's X times P once again. What is that going to be? That's going to be $5. So when you add these two up with the $50 and the $5, your actual payment for Plan A, your expected payment is $55. Whereas your Plan B, even though you pay essentially $0 deductible times 0.01, that's your X and that's your P. That's essentially 0. Your expected value of payment is $60. So which one is cheaper in the long run? You're going to be picking Plan A. Why? Because it costs $5 less. So here, when you read this, in the case your car is totaled, there's a 1% chance. Plan A has the lower expected cost of $55. So when you say this, how can you decide whether or not to purchase replacement insurance? So the replacement insurance is Plan A and then Plan B, right? How can you decide it? Well, you basically want to go for the one that's cheaper, obviously. How can you decide? That's cheaper. So you pick Plan A on the basis that it's going to be cheaper. Now let's try this one. The insurance company also offers safety glass coverage. There's a 50% chance of having no repairs, 30% chance of having minor repairs, and a 20% chance of having full replacement. Which plan for optional safety glass coverage has a lower expected cost? Well, Plan D is pretty simple. Plan D is just straight up $100. What about Plan C? Well, there's a $50 premium, but then there's also all of these probability with its value. So you got to find out the expected value of those. But remember, your deductible is $200. Now that's important because of this right there. Okay, so there's a 50% chance of having 0 repairs, so $0. That's probability times X plus 30% chance of having 50. That's that probability times the value plus 20% chance of the full glass coverage, which is $300. Now, if your deductible is $200, that means you're only subject to paying this as your max amount of dollars that you have to pay out of your pocket. So even though the replacement costs you $300, you're not going to write $300 here. You're going to write actually $200 there because the rest, the extra $100, the insurance covers that. Even though the cost is $300, you're only subject to paying $200. Okay? So when you multiply these two together, probability times X, that is the entire expected values in which you're going to be subject for. This is 0, this is 1.5, and this is going to be 40. Okay? So when you add them all up, it's going to be 41.5, so that's going to be $91.5 in total, essentially. I'm sorry, this is not 1.5, that's 15. So 15 plus 40 plus 50, that's going to give you $105. Okay? So, which one would you like to pick? You would still pick Plan D because even with all of these expected value costs put in total, with the premium, it costs you more than actual Plan B. Okay? So, deductible, premium, how to find the expected value of insurance. That is the main topic for today. You'll get questions like these. Why might this consumer select a policy with $1,000 deductible? With no deductible, you got to think about how many times a consumer might get into an accident. That could sway you in one direction or the other. And then I'm going to ask you to do this portion for your homework. Okay? Have a good weekend. Next week, we'll still be talking about the expected values. We'll take an assessment. Haven't decided yet, but sometime later down next week. Thank you. Have a good day.